consumer sector is not our favorite sector.
There are concerns that new US administration may impose tariffs on other countries.
Domestically oriented companies are going to be more resilient to this. And the earnings growth.
How do you see the Fed progressing through the year? Hello everyone, welcome to the latest episode of Navigate with HSBC. I'm Abhilash Narayan and I'm an investment strategist at the Chief Investment Officer team with HSBC Global Private Banking and Wealth. Now, if you look at the markets, we've had 2 great years for global equity markets. But of late, we have seen the volatility increase and there are concerns around potential policies of the new US administration. To unpack what that means for investors, I have with me today Mr. Willem Sels, who is the Global Chief Investment Officer at HSBC Global Private Banking and Wealth. Welcome, Willem, to the podcast.
Great to be here.
Okay, let's dive right in. So obviously, US economy has done quite well over the past few years. If you look at US earnings, they have surprised markets to the upside. So how do you see the coming year panning out, and what are the pockets of opportunity that you see in US stock markets?
If you go back a year, many people were talking about the risk of a recession, remember, in the US, and people have been underestimating the US economy for more than a year. And that's because the impact of higher interest rates over the last number of years has been much less than people expected. And also because productivity gains have actually been more important than people expected. We think that this will continue. We think that the US economy certainly has very low risk of recession. It will be quite resilient. The new US administration will add to that impetus. And we also think that innovation is going to continue. The earnings growth, which is probably even more important than economic growth for investors, will spread. It's no longer just a magnificent 7. It's going to be those forgotten 493 stocks in the S&P 500 that are going to see that acceleration of earnings. So we are still positive on technology, but we recommend that clients spread their exposure to also include more financials, for example, more telecom companies, and more industrials as well.
You make a great point, right? Obviously, we've seen the technology sector run up quite well. There was some announcement by the new administration that US plans to invest $500 billion in artificial intelligence, and then we saw the big market sell-off with DeepSeek coming through. But if you shift the focus to US administration, obviously, there are concerns that the new US administration may impose tariffs on other countries, and everyone is trying to extrapolate what that means for other countries around the world. If we stop that and focus on US, what does tariff mean for US economy in the coming year or so?
The US is actually a quite domestically oriented economy. They only export less than 19% of worth of GDP in terms of goods export. Compare that to the EU, 30%, or Canada, 58%. So it's quite a domestic economy. So tariffs don't affect them necessarily all that much. We think also that it is going to obviously be staggered. We have been told by the US administration this is also a negotiating tactic. So we hope that not all of them are going to be realized and that it is going to be staggered country by country. It is ultimately a tax on the local consumer. So we do think that that will bite. It is potentially somewhat inflationary. It would potentially hurt more the lower income households rather than the higher income households. So we think that from a consumption perspective, you're going to continue to have what we call the K-shaped consumption, the higher incomes doing well, the lower incomes trading down in terms of consumption. So we think the consumer sector is not our favorite sector. We think rather domestically oriented companies are going to be more resilient to this. And obviously the services sector, which is probably not going to be subject to so much tariffs.
Thanks, Willem. And I think you raised an important point about inflation being a risk if tariffs are imposed. And that has obviously led the markets to reassess their expectations of rate cuts from the Fed. From your perspective, how do you see the Fed progressing through the year? How many rate cuts do we expect? And what are the key data points that investors should watch out for as they could have an implication on the Fed's actual decision making?
So as a European, I tend to think of tariffs a little bit like the experience that we have with VAT, value-added tax. And what you tend to see is that when VAT is raised, you have a one-off impact on inflation, but it basically only lasts, for that particular year, and then afterwards it falls down. So we do think that it will be a temporary impact. It's also limited by two other offsetting factors. We think that oil prices will be capped and potentially come down if indeed more oil is pumped in the US, the supply goes up, and also the strong dollar is a deflationary aspect. That means that inflation shouldn't go up all that much. The Fed, therefore, can continue to cut, we think, 2 or potentially 3 rate cuts from here. But what it means for bond markets is that, because the market expectation is relatively close to our assumptions, you will probably not get big price gains on your bonds. You will clip an interesting coupon. You also will see a lot of volatility. So what we recommend to clients is very much try to take advantage of that volatility by being an active approach or a hedge fund approach.